Hey everyone, my name is Amlan and I'm a financial analyst intern here at 3E Management. And today I have a multifamily acquisitions model from Top Shelf Models that I'll be using to demonstrate what a franchise tax is. So to start off, a franchise tax, also known as privilege tax, refers to a type of tax paid in some states in order to be chartered or to operate in that specific state. The details behind franchise taxes vary from state to state, and some states even hold companies that are chartered in another state liable for taxes. Franchise tax is separate from federal and state income taxes, and they are required to be filed annually in addition to these two other taxes. Um, Nonprofits, fraternal organizations, and limited liability corporations are some examples of organizations that may be exempt from franchise taxes. And while we're on the topic of income tax, I want to quickly demonstrate what the difference is between a franchise tax and an income tax. So to start off, unlike franchise taxes, income taxes depend on how much profit a company makes in a certain year, and franchise taxes must be paid regardless of this income. So that's the main difference. The amount of franchise tax needed to be paid varies depending on the tax rules of that state. Like, for example, some states may calculate it based on assets or net worth, while others may calculate it based on the value of the company's capital stock. On top of this, income tax payments are required from all corporations that bring in income from sources in the state, regardless of whether they conduct business there or not. And conducting business can be defined in different ways. Some define it as the number of employees or physical presence and stuff like that. Now let's talk about how franchise tax applies to real estate and real estate modeling. But before that, real quick, I just want to talk about a few real estate entities that are not subject to franchise tax, meaning they're exempt. And these include real estate mortgage investment conduits and certain real estate investment trusts that qualify to be exempt. All right, so moving on to the model, the first thing you see here is franchise tax is under operating expenses. So the franchise tax works similar to insurance and property taxes in a real estate financial model, and it will have a similar impact to the net operating income, as all these factors are subtracted from the effective gross income to calculate the NOI. And like I mentioned before, it falls under operating expenses, and you can see that here in the annual cash flow section of the model, and also in the assumptions section under operating assumptions. You see the franchise tax right here. So if we were to go back to the annual cash flows model, or even the monthly cash flows model, you see the franchise tax. And if you were to go to that section, you can see that this value is derived from assumptions tab, cell I-28. If I were to go there, you see that I-28 is right here, and that's that 0.5% that applies to the state. And that value is derived from the cell right next to it, which is the per unit annual franchise tax cost. So that's pretty much it. You don't see franchise taxes that they're not that abundant in financial models. The two places that you see them are going to be the cash flow models and the assumption section if your model has one. So in conclusion, franchise taxes or privilege taxes are additional taxes that apply to businesses and real estate depending on the state's tax laws. They differ from state and federal income taxes as they are not dependent on a corporation's or a business asset's profit. And on top of that, some entities don't have to pay franchise taxes. And like I mentioned, these are REITs, nonprofits, and some LLCs.